You finally hand in your notice. You walk out of that climate-controlled office for the last time, box of personal effects in hand, and you feel the weight of the world lift off your shoulders. The commute is over. The endless Zoom meetings are done. You are free. But that night, you lay in bed staring at the ceiling fans spinning in the dark, and a cold thought creeps in. You start wondering if the number in your brokerage account is actually a ticket to freedom, or a ticking time bomb that is going to run out of fuse just as you hit your 80s. We've been told for decades that $1 million is the gold standard for financial independence. It's the cashy headline, the round number, the American dream wrapped in a 7-figure bow. But that fact is crumbling under the weight of modern reality. It is a cruel, almost comedic irony that while stock markets hit record highs and tech companies reach valuations that look like phone numbers, 53% of seniors now believe their income won't actually cover essential goods. And 58%, they are terrified that sticky inflation, that buzzword you keep hearing on the news, will deplete their savings prematurely. Shockingly, even a 7-figure portfolio can vanish in less than 20 years if you fall victim to the sequence of returns risk or the 3.1% inflation rates we are currently seeing in the 2025 and 2026 economic cycle. You might have the money, but do you have the timing? Because if you retire into a recession or into a period where the cost of living spikes while your portfolio stays flat, the math doesn't care about your dreams. It just eats them. To understand why your retirement plan might be built on shifting sand, we have to go back in time. We have to look at the origin story of the financial gospel you've been preached to your entire adult life. It starts in 1994. A financial planner named Bill Bengen sat down with a heavy stack of historical market data and birthed the 4% rule. This rule was designed as a safe harbor, assuming a 30-year retirement window and a balanced portfolio of stocks and bonds. For 30 years, this has been the scripture. It's the gospel of the FIRE movement and traditional financial planning alike. You save 25 times your expenses, you withdraw 4% a year, and you sit margaritas until the end of time. However, the system has changed. We are no longer in the post-World War II boom era. We aren't even in the 1990s tech boom. We are living in a world of universal import tariffs, trade disputes that keep food prices rising by 2.6% annually, and a Federal Reserve that is struggling to hit a 2% target while core prices remain stubbornly elevated. The system that created the 4% rule didn't account for a 40-year early retirement. It didn't account for the modern cost of healthcare, which outpaces general inflation like a sprinter racing a toddler. And it certainly didn't account for the cost of shelter in the 2020s. Think about it. When Bengen wrote his paper, the average home price and the average salary had a relationship that actually made sense. Today, you're looking at a housing market that seems divorced from reality. So are you willing to bet your 80s on a 1990s math equation? Because if you're wrong, you don't get a do-over. You get a greeter job at a big box store when you're 75. Let's break down the updated math based on the latest 2025 and 2026 Morningstar research. And fair warning, this serves as a cold splash of water for anyone planning to quit their job tomorrow. While 4% was the old standard, the new safe starting withdrawal rate for a 90% probability of success over 30 years is actually 3.9%. Now, I can hear you saying, okay, 0.1%, who cares? That's a rounding error. No, it isn't. That 0.1% difference might sound small, but on a large portfolio compounded over decades, it represents thousands of dollars in lost annual spending power. It's the difference between a vacation and a staycation. It's the difference between quality healthcare and hoping for the best. But here is where it gets really dark for the early retirees. If you're looking at a 40-year horizon, meaning you want to retire at 45 or 50, the numbers get even more aggressive. Your safe withdrawal rate drops to a conservative 3.3%. 3.3. That is a massive deviation from the 4% rule. That means for every $1 million you have saved, you can safely spend $33,000 a year, not $40,000. That is a $7,000 pay cut per $1 million invested, right out of the gate. We have to look at this through the lens of a temperature check. If you retire at 65, you have a safety net. You have the average Social Security check, which is currently around $2,015 a month. In that scenario, your portfolio is a secondary engine. It's there to provide the luxuries. But if you retire at 40, your portfolio is the only engine. There is no safety net. There is no government check coming for another 25 years. This brings us to the sticky inflation data. When energy prices rise 4.2%, as we've seen recently, that deviates massively from the theoretical 2% inflation used in old fire models. You need to visualize your retirement portfolio like a fuel tank on a cross-country trip. The 4% rule assumes you're driving on a flat highway with no wind, but reality is driving uphill into a headwind with a car that is getting less efficient every mile. If the wind, which is inflation, is stronger than expected, you won't reach your destination. It doesn't matter if you started with a full tank. You will run out of gas in the middle of the desert. And in this analogy, the desert is being 85 years old and broke. So enough doom and gloom. Let's move from theory to your personal balance sheet. Let's calculate your specific freedom number, because you can't manage what you don't measure. Step 1 is determining your annual expense floor. This isn't what you think you spend. This is looking at your credit card statements, your mortgage, your insurance, and adjusting it for the reality of wholesale price increases. If you think your grocery bill is going to stay flat for 30 years, you are delusional. Factor in that 2.7% wholesale increase we are seeing. Now, to find your portfolio size, we use the inverse multiplier. This is where the magic happens. If you follow the old 4% rule, you multiply your annual expenses by 25. Simple, right? If you need 50 grand, you need 1.25 million. However, based on the 2026 research, for a 3.9% withdrawal rate, you must multiply your expenses by 25.6. That's a higher hurdle. But if you were an early retiree aiming for that 3.3% safety net, your multiplier jumps to 30.3. Let's demonstrate this with real money. If you determine you need $60,000 a year to live a decent life, covering housing, food, healthcare, and a little bit of fun, the old rule said you needed $1.5 million. You hit that number, you pop the champagne, you quit. But the 2026 reality, to maintain that same 90% probability of not running out of money with a 3.3% withdrawal rate, you actually need $1.81 million. That is a $310,000 gap. That is essentially an entire extra house you need to save just to generate the same safety you thought you had. But wait, before you close the laptop and decide you're going to work until you die, there is a silver lining, a massive one. It's called the dynamic spending strategy. The rigid math assumes you are a robot. It assumes that if the market crashes 40%, you will still withdraw your inflation-adjusted check and go buy a new jet ski. But you aren't a robot. You're a human being with a survival instinct. Research shows that if you are willing to tolerate fluctuations, if you are willing to cut your spending when the market is down and spend more when the market is up, you can actually start with a withdrawal rate of nearly 6%. Did you catch that? 6%. This changes everything. This outlines how to build a flexibility buffer. It uses the rule of 30 to ensure you never run out of money, regardless of what the Consumer Price Index does. The strategy is simple. You separate your needs from your wants. Your needs must be covered by the safe withdrawal rate, that 3.3 or 3.9%. But your wants, the travel, the new car, the dining out, those can be funded by the dynamic portion of your portfolio. If the market tanks, you don't go to Italy this year, you go camping. By simply having the flexibility to not spend money during a downturn, you preserve your capital, you stop selling shares at a loss, you allow your portfolio to recover. This is your actionable blueprint. It's not about blindly trusting a rule from 1994. It's about building a math-backed, inflation-adjusted financial independence plan that accounts for the world as it is, not as we wish it was. So look at your number again. Do the math with the 30.3 multiplier. If you are short, don't panic. Just realize that flexibility is the most valuable asset in your portfolio. More valuable than Bitcoin, more valuable than gold, and certainly more valuable than a rigid rule that belongs in a history book. You don't need luck. You just need better math.
Now, go check your spreadsheet.